I was fortunate enough to refinance the residential real estate I own in 2022, and I think I've got one mortgage at 2.3%, another one at 2.7%. If you have a 2.3% mortgage, you've got to have a compelling reason to move, to give up that 2.3% mortgage and go borrow money at 6%. Because if you bought a house that cost the same as the one you sold, your payment's going to go up significantly just because of the difference in interest rate. So on one side, you've got new buyers that are constrained in terms of the cost and the cost of money, and you've got sellers that either bought or refinanced during the post-COVID period where rates were so ridiculously low that really aren't motivated to give up those mortgages. That's kind of got a Mexican standoff in the market.
Welcome to the AAA Storage Podcast, your integrated real estate and development partner exploring all things self-storage investing to bring you diversified success. Let's dive in.
We're back today talking about part 2 of our 3-part series on commercial real estate in our sector breakdown. So last episode, please go check that out at our website, AAAstorageinvestments.com. You can see all our podcast episodes there, as well as additional articles and guides and so on. What we talked about was that we were basically ranking lots of different property types against a grid of different asset classes, sectors, factors, and the way that we were trying to analyze what makes a good real estate investment. And so today's episode, we are going to be talking about industrial, specifically small bay industrial, and self-storage. And so we're going to be looking at this on cap rates, primary demand drivers, liquidity and hold period, risk factors associated with that kind of investment, and investment grade characteristics on that asset. And then later, we've got a relative sector performance and then positioning observations that Paul will walk us through. So Paul, welcome back.
Yeah,
let's talk
always
about
good.
Industrial and small bay industrial. Tell us about that class as you see it.
Yeah, and Brennan, as we get started and dive into industrial and small bay, I think this whole series is really geared to try to connect the dots so that people can better understand how the different characteristics of different sectors in the market, in the commercial real estate market, should impact their decision making in terms of what they invest in. I think there's a lot of these factors people don't think about, or they don't understand how a particular factor in one sector of the market looks totally different in a different segment of the market. So that's really what we're going for here, whether we get there or not. It's a lot of information, and it's probably hard to follow listening to a podcast. So one of the things that we've done is we've created a great guide that I think you just mentioned, but it will be available in the show notes and also available to download on our website, AAAstorageinvestments.com, under the Insights tab. And if this has been interesting at all, but maybe a little confusing, I would strongly suggest you go download the document we've created, because it lays it out in a grid form, and I think it'll really help everything come together and make sense if you go grab that document and then maybe take a second listen to the podcast, and the pieces will come together a little bit better. But we're going to talk about industrial, and in specific small bay industrial, and then self-storage today. And remember that we've covered 7 sectors and 5 primary characteristics of those sectors. In the first episode, we're going to do the same thing with industrial, small bay industrial, and self-storage. So first up is the typical or current cap rate range. The industrial product, the logistical industrial, which is really big box, over 100,000 square feet, is trading in the 4.5 to 6 cap range. The small bay industrial product, really depending on what market it's in, likely trades a tick above that at about 5.5 to 6.5, 6.75, probably 100 basis points higher. And it's primarily because in the big box logistics industrial sector, you're really dealing with institutional grade credits as tenants. And in the small bay space, you tend to be more dealing with local or regional businesses that don't have the same national credit profile. And that added perceived risk ticks cap rates up just a little bit. Remembering one of the things we talked about in the first episode is that one component of cap rate is the likelihood of the continuance of the cash flow. The higher the probability that the cash flow will continue, i.e. a long-term lease from a AAA credit, institutional grade credit, the more the cap rate will compress because the risk is lower. And conversely, when you have a different tenant profile with a slightly less attractive credit profile, then that risk, that the potential for disruption of the cash flow stream is inherently slightly greater, and therefore cap rates expand a little bit. The primary demand drivers in the general industrial space are e-commerce, logistics, manufacturing, reshoring, supply chain modernization. Specifically in the small bay space, it really is that e-commerce piece, and it's also business formation. We talked about business formation as one of the key drivers in self-storage, and it's also a real key driver in the small bay, because small bay is a place where you're going to find HVAC contractor, a plumbing contractor, a pest control business, a landscaping business that's scaled to some degree. A lot of those local and regional, along with e-commerce and last mile logistics companies. And as we've said multiple times, we've even found some very unique consumer uses. We've got pickleball facilities, batting cages, any number of consumer-facing businesses, which we really didn't expect. The next factor that we looked at in each of these sectors in the real estate industry is liquidity and typical hold period. In the industrial space, highly liquid. It's an institutional asset class, and a 5 to 10 year hold is sort of the range of what is common. Small bay as a component of industrial is still evolving. I will tell you, we got an upcoming episode. Actually, it'll probably air before this one now that I think about it, but an episode where we sort of do a mid-year update, and we'll talk about small bay and what's happening with the institutional investor market. It is evolving into a favored asset class, but today probably slightly less liquid than the general industrial category, which is widely accepted and pursued by the institutional investors. The biggest risk in the industrial category, this first one absolutely only applies to the big box logistical industrial real estate, which is overbuilding. That general industrial space over 100,000 square feet saw a lot of development in the 2021 to 2024 timeframe, and like self-storage and like multifamily, saw a downward trend because of a little bit of oversupply. That's been rapidly resolved here as we've moved through 25 and into 26. But it is one of the biggest risks in the general industrial category. In small bay, it may be a risk at some point in the future, but small bay is the opposite of that. It's really supply constrained. With new product coming online. Most of the existing small bay real estate in America was built before 2000, 80% of it, in fact. And there's been very little new supply built since 2010. So the supply and demand dynamics in the general industrial category versus small bay are very different. In fact, they're polar opposites of each other. Another risk in the industrial space is slowing trade and logistics demand. And this is probably an important one, the third one, which is functional obsolescence. You're seeing a lot of technology move into the logistics space. I've got a good friend of mine that manages a 1 million square foot warehouse facility that's essentially run by robots, and obviously a facility built in the 1970s is going to be very difficult to upgrade to some of that modern technology. So functional obsolescence is another risk. The things institutions look for in the general industrial category are more modern facilities in infill logistics corridors with strong transportation access. If you look at the development that's happened over the last 5 years, man, it is all centered around major interstate interchanges and access to that interstate network, because the warehousing business is really driven by the trucking and logistics side of the equation. So, but those are the 5 characteristics of industrial. Overall, industrial is a solid category. And small bay as a subset of that is probably one of, if not the most attractive sectors in all of commercial real estate.
I feel like if you ever have a demand problem in small bay, you could always just turn it into a data center property, just start loading in data centers and selling it to tech companies. And
that's one of the things that's an interesting dynamic, is one of the reasons that small bay is so supply constrained. National occupancy today in small bay on average is about 97%, and there are markets in the U.S. where it's north of 99%. You can't find space to lease. But one of the reasons it's remained supply constrained is that the traditional industrial developers want to build million square foot data centers. It's more efficient for them than building 100,000 square foot small bay business park in 20,000 square foot buildings. And so it has not drawn a lot of attention. I will tell you, again, we'll talk about this in our mid-year update. The reality is the small bay space is being discovered. It's being discovered by the institutional investors, which in turn is sort of perking up the ears of people on the development side of the equation. They tend to not be traditional industrial developers, but they tend to be people like us who have historically done self-storage or another property type, who are beginning to really look hard at small bay. And I think the dynamics of small bay will change over the next 5 to 8 years a little bit. I think it'll be less supply constrained and a little bit more, unfortunately, a discovered sector of the real estate business than it is today. But anyway.
Okay. Well, we'll talk about some of that in the, I know we're talking about relative performance and things like that. So we'll get to that. Okay, give us a rundown on self-storage. I know we've talked about this at length in a lot of our podcasts, but to frame it up in this kind of grid so that we can understand how it performs relative to the others.
Yeah, and absolutely. And there are one or two sectors. Self-storage is now considered a major sector in the real estate industry, and that's why we included it. There are a couple sectors we didn't include. Manufactured housing and mobile home parks are two sectors that have some popularity and some real opportunity, but we just didn't include them because they're still more fringe sectors of the commercial real estate market. But self-storage solidly sort of has a permanent place now in the major sectors within the industry. Cap rates today will range between 5 and 7%. We just sold a property at a 5.3% cap rate. Actually, I say that it's under contract. It'll close in the next couple of weeks. But we've seen cap rates compress from 6.25 down into the low 5 range over the last year, which is pretty substantial. That range is really driven by whether it's a Class A, B, or C facility. A Class A facility would be something like we build, which is an institutional grade product, or excuse me, one of the multi-story, all climate control facilities that you see from the public REITs and some of the larger players. And those properties are the ones that, if they're in the right market and occupancy and net operating income and stability is there, you can see sub 5.5 cap rates. On the other end of the spectrum is the 30,000 square foot gravel lot with a chain link fence around it sitting next to somebody's house. And those are the facilities that are trading in the 7.25, and then obviously there's some in between that. But that's sort of today's cap rate range. The primary demand drivers, and we've done an entire podcast on this, but our population mobility, downsizing, life events, and small business formations. Those are the primary demand drivers, and one component of mobility is related to the housing market. So in the self-storage industry right now, we're seeing moderate growth in demand, and you will not see significant growth in demand until the housing market unlocks and people begin to move more, because 68% of all interstate moves require self-storage on one end or the other or both. So those are the demand drivers. Liquidity and hold period. Institutional liquidity has grown dramatically over the last 10 years and continues to grow. And that liquidity drives a holding period as short as 3 years and up to 7 years. That sort of 3 to 7 year range is fairly common. And if you look across all the industry types, I'm looking back at my notes real quick. Yeah, 3 years would be the shortest hold time the data would tell you for any of the sectors. So the potential to move a self-storage facility, sell it in a fairly short time period is stronger in self-storage than it is in any of the other sectors. Biggest risk, like multifamily, new supply. We've seen that. We've lived that since 2021 through about 2024 when the market, many of the major markets got overbuilt. Short-term lease volatility. A self-storage lease is basically a month-to-month rental agreement. It's not like our small bay product where we have a 3 to 5 year lease, or retail where you may have a 10 or 20 year lease. I will say, however, that the data also shows now that the average stay for a customer in a self-storage facility has actually gotten longer.
Wow.
And the percentage of the U.S. population using self-storage has grown from about 11% to a little bit over 13%. So those are positive trends in terms of volatility. And then revenue sensitivity to local competition is the third risk factor. The biggest battle we face in the self-storage market day to day are large REIT-owned properties. If they're within our local market, we talked about hyper-local markets a lot. We really look at a 3 to 5 mile trade area as what really impacts a particular facility. And if you get a large REIT-owned facility within your hyper-local market, their strategy is often to cut rates, advertise rates to the bone in order to attract occupancy. And that can really put downward pressure on rates. The flip side of that is, unfortunately, and I don't want to call any names, but their strategy is to get you in with a really low rate and then rapidly raise that. Some tenants have seen 6 or 8 rent increases in the first 12 to 14 months they were in a facility. Wow. We don't do that. Some of the large players do, and we're starting to see some backlash from consumers. Self-storage customers are sticky customers. But if you treat them really unfairly, sooner or later they'll cry uncle and just go through the pain of move it out and move into another facility. We're actually starting to see some of that happen. Investment grade characteristics for self-storage are high visibility facilities in growth corridors with strong demographics and barriers to entry. It does not have to be a metropolitan area. As we've said often, we build in the city skirt markets that surround major metropolitan areas, but they're typically very, very high growth, lots of mobility, lots of inward migration, and that's really what makes a good self-storage market, and that's what the institutional buyers look for. So that's sort of a quick run through on industrial and self-storage in terms of their 5 factors and the things that really that develop the character and the nature of those 2 asset classes.
That's helpful. That's such a good compliment to some of the stuff we talked about last episode. I'm curious, you mentioned one of the demand drivers is mobility, and we have talked about that before in a previous episode. But here we are in June 2026, what do you think is one of the things that will unlock the housing market and for folks to be moving more? Is it just interest rates, or how do you think about that?
It's pretty much interest rates. The cost of housing, there's some trends in housing that are actually very positive for self-storage. Because costs have escalated so much, the large tract builders that are building entry-level and sort of second-tier homes have made them smaller in order to make them more affordable. And where they've taken space out of them is often in storage. The closets are smaller, there's less attic space, there's less walk-in attic space on the second floor. Because they're having to design that as more usable, functional living space. Because they're taking several hundred square feet out of the overall plan. That's actually going to drive more usage of storage as people move into those homes, don't have the room to store everything they need, and will put it in a self-storage facility. But truly, right now you've got 2 dynamics. You've got 3 dynamics. 2 of them work together. One of them is the cost of housing. The second is interest rates, and those 2 combined price a lot of people out of the market. The third factor is the spread. So, for example, I was fortunate enough to refinance the residential real estate I own in 2022, And I think I've got one mortgage at 2.3%, and another one at 2.7%. If you have a 2.3% mortgage, you've got to have a compelling reason to move.
Yeah.
To give up that 2.3% mortgage and go borrow money at 6%.
Yeah.
Because if you bought a house that cost the same as the one you sold, your payment's going to go up significantly just because of the difference in interest rate. So on one side, you've got new buyers that are constrained in terms of the cost and the cost of money, and you've got sellers that either bought or refinanced during the post-COVID period where rates were so ridiculously low that really aren't motivated to give up those mortgages. That's kind of got a Mexican standoff in the market until that resolves itself, and it will at some point. Until it resolves itself, you're not going to see robust, housing starts and robust home sales numbers, which is one of the components that drive self-storage usage. So, not the only one, thank goodness, but one of them.
Well, what I'm hearing is my children are going to live in a tiny home with a self-storage unit attached somewhere. So I'm looking forward to that. So,
well, I mean,
right, so
it really, the younger generations today aren't, whether they live in an apartment or they live in their first or second home, they're already using self-storage as an extension of their home. It's where they keep their jet skis, their bikes, all the stuff they don't have room for in the apartment or the small, 1,800 square foot starter home that they bought. We're already seeing that trend in the younger generation. So,
yeah, that's fascinating. Okay, talk to us about relative sector performance, and then you've got some observations regarding positioning if we have some time. But give us the lay of the land on that.
Yeah, I had some real fun. I pulled a lot of data on these 7 sectors in the real estate industry and looked at how they ranked across 5 different aspects that are related to the 5 characteristics that we've talked about for each sector, but not necessarily direct derivatives of them. So the 5 characteristics were: how well did they perform during a recession? In other words, how well do they play defense? Number 2 is how stable is the income? Number 3 is how much operational complexity do they have? Number 4 is the level of institutional capital interest. And number 5 is how well do they perform as a hedge against inflation. So if you can kind of picture those 5 things in your mind, what I did was I took the data for each of the 7 sectors related to those 5 factors and scored it on a scale of 1 to 4. So high would, let's take defensive, how well it plays defense. Low is 1 point, moderate is 2 points, high is 3 points, very high is 4 points. And sort of similar across all the other 5 or 4 factors. And when you add up the numbers, you get a very interesting result. And I promise you, I did not look at the result before I decided whether or not this might be interesting to include. But the best performing sectors across those 5 factors, again, how well does it play defense in a recession? How stable is the income? How operationally complex is it? How much institutional capital interest is there? And how well does it provide a hedge against inflation? The top 2 performing sectors, and they tied, were medical office and self-storage. Out of a possible 20 points, self-storage and medical office both scored 14. Out of a possible, I got to do the math in my head because I ranked the operational complexity as a negative number. In other words, a very high would be a -4, and a low would be a -1. So actually you had 16 possible points for each total across the 5 categories. And self-storage and medical office both scored 14 out of a possible 16. Second place was industrial, which scored 13 points. Third place was multifamily at 12 points. Fourth place was retail. And fifth place tied, again, office and hotel, tied with a total of 4 points. And just to give you an example, I'll use hotel. Defensive ability to play defense in a recession, hotels are very low. When we have a recession, consumer spending drops, people tend to travel less, hotels are more exposed. Income stability ranked as low because you have a new tenant every 24 hours. Operational complexity in the hotel industry, very high, so a -4 there. Institutional capital interest, moderate, so it got 2 points there. And then a hedge against inflation actually performs pretty well, scored 4. But when you take the -4 points for operational complexity into consideration, its score total was a total of 4 points versus self-storage and medical office at 14, so a pretty wide gap. And again, I think if you'll get the document that we put together, because I know this is incredibly hard to follow on a podcast, but if you'll get the document we put together, I think if you think about your investment objectives and your risk tolerance, and you think about the contextual environment that we're in now and that you expect to be in during the holding period you're invested in this real estate, this kind of viewpoint becomes very valuable in making investment decisions.
This is fascinating. This is super helpful too, because you can see, and you've got it color coded here. So you've got high green, low is red, moderate's yellow, and it helps just give this really quick visual on where essentially you want to place your money. If you're thinking about commercial real estate, where do I want to put my chips?
Yeah. We got a minute or two left. Let me hit some just observations from a positioning standpoint, and I won't hit them all. But best historical recession resilience, self-storage and medical office, which is one of the reasons why they scored so high overall. Lowest cap rates, highest pricing, prime industrial and multifamily. Most institutional capital interest, multifamily, institutional, and medical office. Isn't it interesting that when you look at the most, and I'm not talking about most interest, it's actually the most dollars invested in that sector. It's invested in 3 of the top 4 sectors in the list we just went through.
Yeah, makes total sense.
Most challenged traditional sector today, without a doubt, is office, and that's a story that pretty much everybody knows because of the shift to remote work. Interesting that we say that as we talk on a podcast, and I'm actually in my office, but you're working from home. So 50% of the population today works from home. So, and the last one I'll mention as we close up, because I thought, again, this is a little bit self-serving, but this is not my data. The best short to medium hold development strategy is a tie between self-storage and small bay industrial in growth markets, which is exactly what we're doing in Growth Fund 2. And if you go back to how we scored, if you look at self-storage, one of the factors we looked at was liquidity and hold period. In self-storage, the data would tell you that as short as a 3-year holding period is possible in self-storage because of the interest in liquidity, and that's shorter than any other category. And that data comes back around when you look to say, okay, what does the data say is the best short to medium-term hold strategy? And it's both small bay and self-storage. So.
What I love about this presentation, if you will, is you guys have had this thesis for a very long time, and obviously have done very well doing your analysis, making these investments for decades. And you're starting to see that thesis borne out in the institutional grade with that more and more demand there. Yeah. And then you run basically an audit across a wide variety of sectors and factors. And you run all this data and put it in a chart, and it still confirms the thesis that you guys have had for decades. So I just think that's such a fascinating story, and I love that you've kind of done this homework on yourself, but then seeing the results after the fact, it's bearing out, which is cool.
Yeah, I love, if I have a gift, it's understanding how things relate to each other. And this whole idea of this 3-part series really came from a conversation that I had with our marketing director, just talking about how I thought it would be helpful to people to understand how the different sectors relate to each other across the key factors.
Yes.
And I would really encourage you, if this has been interesting at all, to go to the website and grab the document that we put together, because I've really enjoyed putting all this together and working through the data, and I really do think the document will be helpful, just helpful in understanding commercial real estate in general, but also I think it can help you make better investment decisions. So
it's because you're a great marketer, Paul. You can go back with confidence to your marketing director now. This is such a beautiful thing. Yeah,
I am anything but a marketer, my friend.
So definitely go to aaaStorageInvestments.com/insights, where you'll see this guide, and check out the show notes where you'll see a link as well. And then please listen to the episode before this, where you will see a lot more detail on the multifamily, office, retail, hotel, and medical office sectors. And we have one more episode coming up in this series, and we will see you there next time.
Yeah.
Thanks, Paul.
Thanks, Brandon. Take care, buddy.